Good to go?
Good to go.
All right.
Hello, everyone, and welcome to the show. My name is Chris Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
Hey, what's up, everyone? Welcome back to the show. Today, I am very excited to be back on the show to join my co-host, Chris Alaimo, for a little bit of Business Accounting 101 before we kickstart another series of guests. Chris and I have been kind of doing independent research topics, which are definitely very fun, but we're excited to have some new guests on the show coming up pretty soon. So today, we'll be walking through some of the methods of corporate accounting, some key terms you'll see on a 3-statement financial report for a company, the income statement, balance sheet, cash flow statement, all things we've reviewed in prior episodes, but we're going to take more of an accounting focus and some breaking down some of those terms, the accounting concepts, and some key metrics as well. So let's dive in. So 2 types of accounting methods that we're going to cover today in terms of just differentiating the methods themselves. We're not going to go too overly complicated. Just wanted to give a little bit of a preface of what are the different methods of accounting, and especially if it's brought up, during a financial call, which it's unlikely that you'd hear something about the cash basis, but we'll discuss the details and the differences and maybe some of the benefits of one versus the other. So there are 2 major accounting methods when it comes to corporate finance, and one of them is the accrual accounting method, and the other is cash basis accounting. And the main difference between these 2 methods really lies in how the timing of the revenue expenses are basically recognized on the financial statements. So let's start with the cost basis or on the cash basis. This one is hands down the simplest of the 2 methods. And the cash basis essentially is what reports revenue on the income statement only when the cash is received. And essentially what that means is as soon as cash hits the bank account, that's when it's recorded. So expenses as well are only recorded when cash is paid out. And this is typically used by small businesses and for personal finances. It's definitely the most, or I guess least cumbersome method where you're really only relying on when cash is changing hands. It's like if you wanted to, track the financials of your lemonade stand that you're setting up outside. As soon as that quarter goes in for the lemonade, or dollar now, depending on, with these inflation numbers, it's ridiculous. But let's say $1 lemonade, you would only be reporting that dollar as soon as the dollar goes into the cash register.
Yeah,
Now,
and I'll make a note real quick. I personally like this method better. I know this is more for small business and personal finance. I guess the reason that big business kind of goes away from this method is that they have much bigger balance sheets. Apple can literally float $1 billion, $10 billion, $20 billion, and they probably wouldn't even be affected by it. They just have that much cash on hand that, they eventually want to get paid, and their accounts receivable department will definitely be hounding the people that haven't paid them yet. But for the most part, they can float that, and they can write that off as a business expense and say, this is the revenue we should be coming in, but, we're waiting for payment still to come through, whether it's through credit cards or financing or whatever it may be, basically.
yeah, that's a good point, Chris. It's definitely the most grounded in reality accounting method by far, because those transactions are based in certainty. That cash has been paid out. That cash has been truly received. The rest sort of is the next method that we'll kind of talk about, where you can kind of think of it as credit tracking accounting. It's called the accrual accounting method. And there's definitely a wider, or you're definitely a little bit further out on the risk spectrum in terms of just your commitment to reporting, because there are some things that, when you're dealing with any sort of system of credit, there's always the risk of default. And that risk of default goes 2 ways, both from the company in the debit side paying out, and then so the accounts payable, which we'll talk about, and then also on the receipt for credit for accounts received. Go ahead, Chris.
Yeah. No, I think that's spot on. Like I said, big businesses normally use the accrual accounting method. They can kind of float cash on their balance sheets much easier than a small business
Yeah.
and or a personal finance person.
Yeah.
Go ahead.
And with that, sorry, I glossed over. You just had an inquisitive look in your face.
Yeah.
The accrual accounting method, just to give it a quick summary, just where you kind of tie it into the cash basis, is it's revenue accounted for when it is earned or owed rather. And typically revenue is recorded before any money even changes hands. And sort of differentiating between the cash method, the accrual method records revenue when a product or service is delivered to a customer with the expectation that that money will be paid in the future. And these expenses of goods and services are recorded despite no cash ever be paying out for those expenses. So again, like what Chris and I talked about, it's really a system of credit and debit.
Yeah. So now we're moving on to the income statement. I know Ben and I have talked about the income statement, the balance sheet, and the cash flow statement before. Income statements, we're just going to go through them just broadly and a lot of the terms that appear on those sheets. The income statement's also known as a profit loss or a P&L statement. So, a lot of times companies prefer to use the profit loss instead of income statement. Personally, I don't really like that. I get the nomenclature and the reasoning. I just prefer the income statement nomenclature personally. So basically, this is kind of a snapshot of your business income and expenses during a given period of time. Normally, it's done by the trailing 12 months is a lot of times what's reported. Obviously, at the end of quarters and years, they obviously report that, in those bifurcations or those specific things. But normally, it's done, quarterly, and then they have a rolling 12-month as a comparison. One of the terms that's commonly used on it is COGS, or cost of goods sold. So the cost of goods sold are the expenses that directly relate to the creation of a product or service. Not included in this category are the costs that are needed to run the business. Example of COGS would be the cost of materials or the direct labor to provide a service. So it is, quite literally the cost to buy whatever the components are to build whatever it is. The next one that's kind of a big one is depreciation. I know a lot of companies use the acronym EBITDA for like evaluating their businesses. EBITDA stands for expenses before interest, debt, taxes, what is it? No, depreciation, and amortization. So one of the terms in that is depreciation. Basically, that's a term that accounts for the loss of value of an asset over time. So what businesses are allowed to do, or even individuals can do this. We'd recommend you speak to a tax advisor. If you have a business and you're running a small business, you can say, let's just say we buy a car for $50,000. And it, all of a sudden you drive it off the lot and it drops to $40,000 or $35,000. I know that's contrary to what's going on with used cars right now. They're going through the roof. But in the normal circumstances of reality, when it's grounded in reality, normally it depreciates as soon as you leave the lot. So in that case, you can write that off as a business expense. So saying you had a loss of $15,000, so from $50,000 to $35,000, and you're allowed to depreciate that against your balance sheet as almost a cost. So if you make, let's just say you made $50,000 or $100,000 of profit, you can take $15,000 off and say that you didn't make that money. That's, you subtract the depreciation from what you actually made or your revenue. So it's a way that businesses pay less taxes.
Yeah, it's a really helpful tool, actually. And I know that I think it was the Tax Cuts and Jobs Act of maybe, was that 2020? I think when that passed, or was that 2017? One of the years. It, especially speaking about the automotive side, it's a really huge benefit. It's called bonus depreciation. So I think it's for the first year, if you were to claim the purchase of a new or even used vehicle, you can claim, you can depreciate 100% of it in the first year, up to like a certain limit. So it's very, very advantageous for, let's say a company is having a bad year. They can use that if they need to buy fleet vehicles for their company to really reduce their taxable income. So it's definitely a useful tool if you're running a small or even large business.
Definitely. The next one is an expense. This is pretty easy. Ben and I have talked about this a bunch. It's just a cost incurred by a business. Very simple term, easy to understand. Next one is gross margin. So margin is the percentage calculated by taking gross profit and dividing it by the revenue. So basically, for the same period, it represents the profitability of the company after deducting the cost of goods sold. So basically, it's you're subtracting out the cost of goods. So exactly what we were saying, the COGS, you're basically removing that from the equation. So you're getting your profit margin or gross profit. Your gross margin, meaning that it's like it cost 200 million to buy it, but we made 300 million. So we made 100 million of gross profit. And then that's not subtracting out all the other business expenses, basically.
Yep. And really maybe I should have put the gross profit above gross margin, honestly, but gross profit indicates the level of profitability of a company, which doesn't take into account overhead. And it's calculated just like Chris said, by subtracting off the cost of goods sold from revenue. So going back to that gross margin, you basically take the gross profit that we just defined and divide revenue, and then you get your gross margin. And that's just definitely a good thing to see and track. It gives a little bit more of a weighted average of how, or at least the level of profitability from a percentage standpoint. If you want to look at companies from, quarter to quarter, year over year. So if you're looking at like Q1 2021 to Q1 2020, the gross margin is something, depending on the seasonality of the business, it's a good indicator for how the company's performing from a profitability standpoint. Now, net income is essentially just the dollar amount that's earned in profits. And I guess you can kind of think of, well, gross profit is a little bit different from net income, because in order to get net income, you take revenue and then you subtract all of the expenses in a given period, including COGS, now taking into account overhead, depreciation, and taxes. So very different from sort of the exclusive EBITDA, which gets rid of some of these items. I think net income is the best item to look at. That's what they're calculating EPS on as well, the earnings per share. That's profit. It's your true profit. Next is the net margin. This is, again, still on the income statement here. The net margin is the percent amount that really illustrates the profitability of a company in relation to its revenue. So this is comparing profit to revenue, and this is net profit. So it's calculated by taking the net income and dividing it by the revenue for a given period. And depending on what you want to measure, the time period is fully flexible. But the difference between net margin and gross margin is that the net margin, or the net income, is really the net profit after those expenses have been subtracted, and the gross margin takes the gross profit, which excludes pretty much everything but cost of goods sold. And lastly, really this is what people talk about, the top line is revenue, or in other words, sales. Those are totally interchangeable. Revenue and sales, it just depends on the business. They may choose one or the other, and they may interchange it. But really, the revenue is any money that's earned by the business.
Yeah. Now we're getting into the balance sheet. So this is basically
the balance sheet.
Yeah, a balance sheet's a good one. So basically, it's a snapshot of the business financials at a single point in time. That's kind of very important to say. And basically what it is, I actually don't really like this definition, but it's basically showing the assets and the liabilities of the business. So there's always, a balance sheet, it has to balance. So, it's like, the equation has to be equal on both sides. We're going back to basic algebra here, but that's basically what it is. A lot of times businesses like to do, I like to call them company wonky accounting principles, where they say one thing's an asset that's not, or they write off a liability that they shouldn't. I won't be the one to judge what companies do that or how they get weird with it. I'll leave that up to the tax professionals. But basically, two of the terms that appear on it are accounts payable and accounts receivable. So accounts payable is exactly what it sounds like. It is something that is payable to another business. This account is recorded as a liability on the balance sheet, because if I were to buy something from Ben to produce something for my car or widget or whatever it is, let's just say I buy $100 worth of something from Ben, and I say, hey, Ben, I'm going to pay you in 60 days. We have net 60 terms, meaning that he gives me the good, he ships it to me, the tax, the shipping and handling costs, and the cost of the good I pick up. And then eventually in 60 days, I'm going to pay him. So it'll go down as an accounts payable. And, if I pay him sooner, Ben's happy. We're maybe not as thrilled because we don't get to float our cash flow as long. But as long as we meet the terms of the deal and pay him within 60 days and he agreed to it, we should all leave happy. Then there's accounts receivable. So this is kind of the reverse. Ben is one of our customers. We provide him a car, a house, whatever it may be. And he says, I will pay you back in 60 days, 90 days, 180 days, whatever it may be, or longer, whatever terms we agree on. And basically, he's saying, I promise I will pay you back eventually, whatever the net terms are. I kind of see accounts receivable as more of a liability as well. I know it's a lot of times in accounting, it's seen as an asset, but exactly like Ben said, it's risky because there's always a chance of Ben defaulting. If I have a long-standing relationship with Ben, I don't expect that to happen, or expect my debts will be paid from him. I see him as a trustworthy client, but in the times of economic downturn, things can be very crazy. I like to relate this back to a personal balance sheet. So we always talk about businesses, but here's a perfect one. It works really well with cars and houses. So let's just say we buy a house for $100,000. I put down 20% equity in the home. So I put up $20,000. That is seen as an asset. So that $20,000 is an asset. I think we've described this before. So $20,000 is an asset. The $80,000 that I now have to take out a loan from the bank is a liability. So in a perfect world, when you're doing a balance sheet at a specific point in time, let's just say in a year from now, the housing market crashes by 50%. So even though I put in 20,000 into the house and I have 80,000 outstanding, it gets really wonky that, the value of the house drops to 50,000. I still owe the 80,000, but my equity in the home has now diminished to $10,000. And if I were to sell the house in a panic at $50,000, I still, once I close on the house, I owe $40,000 or whatever I do. I have to carry that over my new balance. I have to take out a new loan. Or I have to, if I'm buying a new place or I'm renting a place, I have a $40,000 mortgage I still need to pay while also renting or buying a new home at a new price, or maybe I'm buying at a bottom. But still, that's kind of the way that it breaks down. So this is kind of a way that we saw the housing market crash. It's more complex than that, but that's a perfect example. And the reverse is true. So let's just say your house goes up to 200,000. You can reevaluate your house, and they're going to say, hey, the equity in your house is now $40,000 at this point in time, plus whatever payments, less interest, and including the principal. So 40,000 plus your principal payments, same as the reverse of the other way as well. I hope that makes sense from a personal standpoint.
Yeah, Chris, actually, I thought that was a really good explanation, because the house purchase and even on the car purchase, when you make that sale, it's really not a simplistic transfer that's like, oh, if I sell it, I'm done with it. It's like, okay, well, what is the car? Think about the car specifically. What is your car worth? What do you owe? And that can really change the equation for you in terms of, are you just losing money instantaneously by selling? So knowing what you own in terms of equity versus value is a very big, important thing to understand. So Chris, I thought that was a really good example, honestly.
Thank you. And then I guess we'll go with the last term that I have, and then I'll pass it over to Ben. So an expense that has been incurred, or an accrued expense, an expense that has been incurred, but it hasn't been paid by the term accrued expense. So once again, this would kind of be seen as this would go on accounts payable. It's called an accrued expense, and we haven't paid it yet, but we have to pay it eventually. So this is something accounts payable is kind of the group that deals with all the expenses, or it's the lumping of that. The accrued expense would be a line item on there.
Yeah, that's something that would be tracked with the accrual accounting method for sure.
Yeah.
Cool. So I'm going to discuss asset, and I know it's something we've discussed as well, but thinking about it from the accounting side, there's actually a thing called the accounting equation. And the formula is very, very simple. It's A equals L plus E. And the A, which is the left side of the equal sign, is assets. And what that is equal to is the L plus E. And that's liabilities plus equity. So your assets equal your liabilities plus equity, and the liabilities being a negative and equity being a positive. And that's really just like the overriding principle of like essentially corporate accounting. So assets, the A, and this is really anything that the company owns and has monetary value. And these things are listed in terms of their liquidity, in order of their liquidity, from cash or cash equivalents being the most liquid, all the way to the least liquid. So we'll move on to, well, maybe I'll jump really quick. I'm going to go a little bit out of alphabetical order. So we looked at the left side of the accounting equation, and that's assets. On the right side of the equal sign, the first term is L, and that is your liabilities. So this is all of the debts that a company has yet to pay and are referred to as liabilities. And some common liabilities are accounts payable, payroll, loans, etc. And that typically would be denoted in sort of a negative notation. And then next, the final term of the accounting equation, the E, which is equity. In the most general sense, equity is really just assets minus liability. That's how you kind of get to it. And that's really just manipulation of the equation. So an owner's equity, to sort of be specific about that side, that's typically explained in terms of the percentage of stock that a person has ownership of in terms of interest in the company, and the owners of the stock are the shareholders. So again, going back to the accounting equation, it's A equals L plus E. So Chris, anything to talk about on that before I punch out the last two? I think it's just last two.
Yeah. So I guess my thing that I'll definitely add, I know Ben and I talk about the hierarchy of you would never want to think of a company going bankrupt, but in the case of it going bankrupt, there's kind of the three pillars that it pays. So if you think about it, payroll is kind of always protected. Obviously, companies take measures that, the best companies make sure that everyone gets paid on any given week. So that's kind of always the first thing that's protected. If some people aren't getting paychecks, they're going to get frustrated and leave, or, they're going to have to take a pay cut because the company says so. I know a lot of people during the pandemic took, either were laid off or furloughed or took pay cuts or, a lot of different things because all the businesses kind of in general were in trouble. But if you're thinking a business is going bankrupt, let's just say, worst case scenario, typically, even though a company's declaring bankruptcy, people will still be getting paid for whenever the bankruptcy gets filed, before they actually get laid off. So they will still be getting paid with the assets that are remaining on it. The next people to get paid are the bondholders or the debt holders. Normally, those are the big banks, the investment banks. They get paid first. And then normally in the last case scenario, the shareholders or the equity holders normally get paid last. So if you are a shareholder of a company and it goes bankrupt, more often than not, unless there's a reorganization and another company buys it, you have zero and your asset went to zero and you literally have zero. So $0 or, you didn't get paid out for it. That's not always the case. We just saw a perfect example of this with Hertz. A lot of people were buying the stock, which I did not think was a smart idea when they declared bankruptcy, but then they got reorganized. I forget who bought them, but they basically got bought, and actually people saw their share prices buying at a bottom and actually like 4 or 5x their money. I think it was like at $1.25 a share, $1.50 a share, and went up to like $8 or something like that. So I mean, give props to the people that went into that trade. That's not something that I was willing to venture or risk.
Yeah, that was a good explanation. And Hertz is a good example of that. Definitely a trade I was keeping my eye on, but I don't know the rental agency. Again, it's one of those things that you can always, if you want to use sort of that like throwaway money, it's something you definitely want to keep to a very, very intentional percentage of your investment strategy. But for things like that, like if you're a deep value investor and you're trying to get more involved in that, looking for companies that you maybe have done the research and believe they can come out of bankruptcy when the news you believe is oversold, that's a really opportunistic opportunity. If you think that there could be a buyout, like Chris said, you could be making 8x your money. Not all the time, and a lot of times things go to zero.
Yeah, in the wise words of Deep Effing Value, I like the stock. That's his words, not mine. So I didn't like the stock, but very clever in analysis for the people that actually made out well. And I give them all the props for doing that. The people that were selling it off, they're kind of the ones that either sold at a loss or they're the ones that kind of got burned in the trade.
Yeah. And to that note, another sort of useful metric to look at for looking at maybe underpriced assets, the book value is a useful metric for that. And how do you get book value or BV? It's essentially the value of an asset, or really what book value is. It shows the original value of an asset minus any accumulated depreciation. And book value is, I think, from a company standpoint, which is more broad than this definition that I just gave, the book value is really just like the full value of the company's assets. So that would be the book value of a stock. That's all the company's assets less depreciation. And at times, companies can trade below their book value. It's rare and it doesn't always come by, but that's something that Warren Buffett has done when he did the Goldman Sachs, I think it was preferred stock deal, when he was buying Goldman Sachs preferred shares when they were trading below book value. And that was a very lucrative trade for him. It's a nice method if you believe that the business has strong fundamentals and is on a good financial footing. If you find that they're trading under book value, if they were to liquidate everything they owned, you would make immediate money on just the sale of assets, because regardless of what the stock price is trading, if they just sold their assets and liquidated, you make money. Just looking at from like a real estate or book value play, it's something to look at.
Correct me if I'm wrong, but I think during the 2008 financial crisis, when he got that preferred stock options from Goldman Sachs, and to be clear, he turned away Bear Stearns. Bear Stearns sent him like an emergency report the day before Christmas or the day before Easter. I forget what it was, that they were like, "Hey, Warren, we want you to buy us." And he looked at it. He's like, "You're disrupting me Christmas Eve or Christmas Eve." And he looked at it over the weekend and he's like, "This is a horrible company. Like, they're way over leveraged." So he passed on the offer. Bear Stearns ultimately went bankrupt. But in in the light of the 2008 financial crisis, I believe Warren Buffett took over Goldman Sachs because the board was basically either, fired. I think a lot of them should be in jail. I just was telling Ben the other night, I watched The Big Short and The Inside Job, and they're just really eye-opening for the amount of fraud among investment bankers, central bankers, and just bankers in general. I mean, I'm not punching down on people that are tellers and work at banks, but definitely the higher ups and the senior execs, not too fond of them. But anyway, I believe he took over Goldman Sachs. Correct me if I'm wrong, but for like 180 days or 360 days, and he was not a tyrant, but he's like, you guys should all be fired. And he's like, he basically wiped out the board. He ran the company for a year. He said it was very stressful. I believe it was that. I'll have to look it up. But he took over the company because I think either Bush or Obama asked him to take over and basically just clean the act up of these banks. That way they don't default and crash the whole global economy, which they ended up doing, but it would have been a lot worse had he not taken over.
Yeah, 2008 is 100% right. And it was $5 billion when he made that trade. But I can't remember.
I thought he was on the board. I thought maybe not the
right.
CEO, but I think he took basically not a hostile takeover, but essentially he's like, all right,
it was an activist investment.
Yeah,
sure.
exactly. He sat on the board and said this is how things are going to go for the next year.
Yeah, obviously, I think he bought a controlling interest. I don't know how much. We can confirm that though, but yeah. I think you're right for sure.
Yeah.
So we'll clarify. I just don't know. I think that's right, and that's what I thought too. I don't know offhand.
If anyone wants to put in the comments, we'd love to hear. I know there was a certain company that he did, whether it was Goldman Sachs or not, remains to be seen.
Because it was a big buy. It was a massive buy. To save their future essentially.
Yeah, he basically gave him cash and he said, "I control this now."
Yeah, it was a big deal. It was $5 billion in 2008, I think.
Which is a lot of money now, and even more so back
always.
then.
For now, at least. So okay, last term for the balance sheet, inventory, and this is definitely. You can kind of intuit what this means, but it's the term to classify the assets that a company has purchased and what they plan to sell to customers, but remains unsold. So as these items are sold to customers, the inventory account will lower. So the inventory is really just the cash register of items. It's things that are not owed to anyone, but it's a warehouse. You can kind of think about it as the company's warehouse of things. All right. You want to jump into the cash flow statement? I can definitely kick that one off if you want.
Yeah, if you want to kick that off in the first term as well.
So the cash flow statement, this is, I do love myself a good balance sheet, but I think the cash flow statement is my favorite because it really reconciles into your overall free cash flow. And that's really what I rely on to do a lot of my valuation stuff for businesses broadly. So I really love the cash flow statement. I think it's more of a dynamic sheet. So essentially what the cash flow statement is it analyzes your business's operating, financing, and investing activities to show how and where you're receiving and spending money. And the first section that you'll see in a cash flow statement, and again, they vary, but these are kind of the three components that we'll walk through of the cash flow statement. And the first one is cash flows from operations. Really what this is generally is transactions from all business related activities. And it starts with net income. There's definitely a lot of parallels between the cash flow statement and income statement. It really matters about timing. But this section begins with net income, and then it reconciles all the non-cash items to cash involving operational activities. Essentially, it's the company's net income, but in the cash version. And this section reports cash flows and outflows that are directly stemmed from a company's main business activities. So this is something that's really helpful to see. This gets you a little bit closer to the cash basis accounting to see that what is grounded in reality is this section.
Yeah. So I'll take over cash flow from investing. So normally this is the result of investments, gains and losses. So if a company is holding equity of another company, investments that they've made, whether that's a purchase of a property, an office building, whether, they rent a building. So it's just kind of a lot of different things in terms of that. This section also includes cash spent on, like I said, property, plant equipment, and helps investors track the CapEx. So CapEx, I know it's a term that we didn't define, but CapEx is basically the capital expenditure for long, or capital expense is the money an organization or corporate entity spends to buy, maintain, improve its fixed assets, such as buildings, vehicle, equipment, and land. This is kind of a really big one, especially for manufacturing. So the Teslas, Ben and I's, Ben's previous company, Covanta, where you're maintaining the facilities with the waste to energy facilities, or when you're just maintaining processes, you always have to upgrade pipes, equipment, you name it, like safety procedures, whatever it may be. That's kind of normally in your CapEx, big, large expenditures to upgrade things. When CapEx increases, normally for that given year, so the company normally announces this is what's going to be our CapEx this year. If let's just say it was 100 million, and then the next year, like it's going to be 200 million, you can normally expect a reduction in cash flow, and high CapEx typically indicates future growth, meaning that they're investing in a lot in the business now for future growth and profitability, basically.
Yeah, and that was definitely a note I saw doing more research on like CapEx, on how investors like to look at CapEx, just comparing against like my own sort of inclinations. They always made it. I don't know. I felt it was a little bit reductive to just assume that that was like my parentheses there in the notes. But not always. People are really pushing that CapEx is a good indicator for growth, but exactly to Chris's point, in even just understanding the definition of CapEx, the capital expenditure, it's also inclusive of maintenance. So you can have plants and facilities and equipment or factories that just require preventative maintenance, scheduling, and that's not necessarily going to lead to some sort of like growth metric or go forward growth, but rather more of a status quo. So
or sustain, yeah, definitely.
Yeah, CapEx is, I think it's a good thing to keep an eye on, and it helps you to make sense of like whether purchasing in a given quarter or time period is in the norm or out of the norm, but it's not always an indicator of growth. I think you really have to assign some specific line items into that CapEx to make sense of it. Broadly looking at the total won't tell you the story at all. I think CapEx is a good item to look at and understand, but just seeing the number and the trend, it won't tell the story.
Here, and I'll just add one little caveat there. I mean, perfect example, if you have a poor senior leadership team of any company, and they do poor CapEx projects, they spent a lot, but if you don't get your return on it, that wasn't a good investment. Or exactly to Ben's point, if you have high maintenance costs and you're just kind of maintaining the status quo or getting back to normal, you're not improving the process or your products at all.
Exactly. And something to track if you want to assign, and I'll move to the last section in a moment, but I think something to track exactly what you just said, Chris. They can spend money, but it doesn't always correlate to really the bottom line. A metric that is good to look at, and I don't know if we included this for sort of our rapid fire round at the end. I don't think we did, is return on invested capital. That percentage, taking a look at that and tracking the capital spend over time, if that return on investment capital, which is typically expressed in a percentage, but it depends on how you want to break it down, it's probably a percentage. If increased CapEx is not sort of correlating with at least a steady or increasing ROIC, maybe a cause for concern. I think there's always level of explanation. Like there's no hard and fast rules, but that's one metric to sort of reconcile a trend in changes with CapEx. Cool. Last section, cash flows from financing. So this, again, more things can be included or less things, but typically these are the three sections: the cash flows from operations, investing, and financing. And the cash flows from financing section, this section measures how cash flow between the company and its owners and creditors is sort of moving. And this is usually expressed in the form of debt or equity. It's reported annually in the 10K. And this section is really helpful because it helps you to figure out how much money the company paid out in its dividends or its share buybacks. I think that's really helpful to see what the company is thinking long term. You can maybe get some like a bit of a litmus test from this. If you're seeing the company's buying shares in mass, like that's not, again, anything I'm saying is it's not an always thing, but it's something to think about. If you see that your company is buying a lot of shares higher than historical averages, that's probably a good sign that they believe that that company is undervalued. And like, who better to know to buy those shares than the company themselves, because that's truly the most inside information you can possibly get, and it's legal. So if you're seeing that your company is buying back shares, that's like a good sign. It also takes off shares out of the float, which is going to generally increase the price. It's just generally a good sign to
I will
that the company believes
I'll
in
put a
itself.
one little caveat on that.
Sure.
If they're buying back shares and then all of a sudden you see a lot of their execs, which is public knowledge, that are selling off a lot of the shares, that's more of a short-term thinking versus if they buy more shares and you see a lot of the senior execs buying more, that's normally a good thing. But if you see the reverse, it means that I don't want to say they're being fraudulent, but they could be just like looking short-term profit of, we're going to buy back our share, we're going to bump up the share price to activate our options, because a lot of times in senior leadership there is there'll be like an option for 1 million shares of the company if you hit the strike price of $16. And if your share was trading at $8 and it jumps up to 20 or whatever it may be, if as long as it hits that strike price, you get paid your option, and then they sell it they cash out. And basically that's really very short-term thinking. You like to see long leadership teams, a CEO that's been there, 5, 6, 7, 8 years. I know traditionally the turnover of CEOs is like 5 years, 4 years, if that. I know it's been getting shorter, but like a Warren Buffett, like he's been there for 70 years, 60 years now, him and Charlie. If you see them buying back their stock, normally they're good people to trust, to think that they see that their stock is severely undervalued.
Yeah, that's helpful. And again, I think like read between the lines, like just because someone's selling and you see it in like a Yahoo Finance article that's like, oh, this executive sold X number of shares. But again, fine tune the numbers, be like, how much shares do they actually own? Are they just profit taking for a little bit? Because like if they want to buy a boat, like Jeff Bezos buying his ridiculous yacht, maybe he sold some Amazon shares. But it is very important to kind of understand the mentality of leadership with sort of the decisions of the company. And with the executive leadership team, if they're like essentially EVP or executive vice president or C-suite level, if it's a publicly traded company, they'll have to report compensation. So you'll see how much those individual officers are making and how they're compensated. Compensation is a really important metric, or I guess feature to look at for companies, because you sort of see how leadership is incentivized, and it may indicate why they're doing certain behaviors. It might overturn what you think is actually an issue or not. So just something to be mindful of.
My favorite Charlie Munger quote: "Show me the incentives and I'll show you the outcome." That's definitely a big one. I know also when you're at the top of a company, you're considered an insider. I know that that's typical of people that own more than 10% of a certain company. So the Jeff Bezos, the Elon Musk, and stuff like that. There is also rules for if you own less, but you're in a senior leadership or board position. A lot of times, to prevent insider trading laws of these high executives, sometimes they need to time their buys and sells, meaning that they can't get a benefit compared to the street. So a lot of times if they want to, let's just say the CEO wants to sell, 1,000 shares, 50,000 shares, whatever it may be, if it's above a certain limit, basically, or a certain of their percentage, don't quote me on this, but I know that they have to report like if they want to sell it, they can't do it tomorrow. A lot of times it has to be done in 6 months or in a year's time frame, or what, like basically they have to go to the SEC and basically, or their accountant, and say like, hey, I want to sell X number of shares on this date. Because I know the Pfizer or Moderna CEO, right before the announcement of the vaccines last July or August, he sold a lot of his shares, or a decent amount of his shares. And people are like, they were kind of going up in arms saying he knows something. They don't work. They do work. He's selling them and then rebuying. There was all these crazy things. Basically, he had marked the year before or 2 years before that on this date, he wanted to sell X number of shares. So it was not as big of a deal as people were alluding or making it out to be.
Yeah, that's a good point, Chris. It's always important to just like take that next step, that when you see those, like, again, especially with investing, if you're making financial decisions on the headline, you're already making a mistake. Mm-hmm. I think it's good to use headlines as a point to start from, but using that as your basis for decisions is probably not great unless you're running some sort of like day trading AI. But even then, you leave it to Wall Street.
Yeah, I mean, in exactly what Ben's saying. A lot of times those articles are trying to draw eyeballs and, pull views. So you're trading on emotion when you're enacting on an article that was written by Yahoo Finance or the Wall Street Journal or the New York Times. Like if they're doing a stock thing, they want like, oh my God, the CEO sells it right before a big announcement of the company. It's like, all right, take a time out, step back. Maybe this was already predetermined and scheduled to be sold regardless of the news. So a lot of times it could also be seen as like a CEO hedging its bets. If you sell and the news that you're going to announce is going to make it go up, why would you sell? So a lot of times with the scheduled thing, it's just like, they don't get the upside as much. Yeah, they still have shares or some shares, but they also don't get the downside. So a lot of times it's executives trying to take liquidity off the table for, whether that's their lifestyle or to invest in something else or to diversify. I'll leave it up to them and their accountants for whatever their reason for selling is.
Yeah, and I think it makes sense. Sorry, I know we're kind of splitting hairs on this one topic, but I don't know. I think it's important to understand. Unless I feel like you would see it more likely with, unless it's in their contract, but also with like a founder CEO, you'll probably see them holding on to shares a lot longer just because they have sort of emotional tie to it. And I think it behooves them to show that they're fully committed in the development of a business. But when you kind of have like a hired gun CEO who kind of came onto a legacy company, like when you think about it, and I advocate for this for anyone really, that if you receive company stock, you should definitely make sure you set up a comfortable allocation. I think people have been burned before where you are being paid in dividends, essentially. That's your salary. That's your paycheck every 2 weeks or bi-monthly or whatever. And then to get stock as well and to hold on to that, you're all in. That's all of your eggs being in one basket. So I tend to advocate for folks to give yourself some liquidity and diversify out of your own company, because it's just arbitrary that you work at that one given company unless you founded it. Make sure you don't dig yourself in a hole in terms of the risk spectrum. But again, do what you're comfortable with and talk to a financial advisor.
Yeah, I mean, Jeff Bezos had all his eggs in one basket. Here's a perfect example. So I know he has like 5.7 million shares of Amazon, and I don't think, maybe he's more diversified now because he's definitely got a lot of assets under his name. But perfect example. Well, before, we keep talking about this, but I think it's just really important, a lot of this. Let's just say Jeff Bezos only had 100 shares, just to make it easy. Normally, if a stock split occurs, let's just say they go 5-1, meaning that for every one share you have, you get a 5. A lot of times what you'll see is after companies do a stock split, they're doing that for people that are long-term shareholders to pull out liquidity. So if Jeff Bezos had 100 shares of stock and he wanted to sell 50 of them, he would only have his 50% of his remaining amount. Obviously, there's other people in the market. But if he wanted to sell 50 shares, but then all of a sudden they split it to 500, and he sells 50, that's only, what is that? That's only 10% of the total sale versus 50% if you're to sell 50 of the 100 that he had. If he sells 50 of 500, yeah, it's less amount, but he's giving up less equity of his business to do so. So a lot of times when companies do stock splits, a lot of times either their senior leadership team or founders or the board have a lot of stock. They like where the business is going, and they just basically split the pie into more pieces, and they only want to sell a small piece instead of a much larger piece.
Yeah, good point. And NVIDIA is one of those things that are splitting pretty soon. So if anyone has NVIDIA and you've never seen a stock split before, you're going to be getting 4 for 1. So for every NVIDIA share you own, you're going to have 4. So very exciting. Okay. You want to do the rapid fire on just general concepts?
We're going to go down the list here. So a lot of rapid fire general comments here. So credit is an increase in a liability or equity account. So, or a decrease in an asset or expense account. So basically credit, you use a credit card. I buy something for $50 from Wawa or whatever store. I have to pay them back on a later date. A lot of times for credit cards specifically, as long as you pay it when your balance comes due, you don't pay the minimum, you don't pay the interest on that. Obviously, they're just kind of, you're borrowing money from them, and if you pay it off in full, you're normally pretty good. A lot can be said, the same for also businesses. I know a lot of businesses will have terms that, in the first 15 days, if you pay early, we'll give you a 2% discount, or they'll give you a discount or incentivize you for paying early because then they get the cash up front. If not, it's the normal net 30, net 60 terms.
Great. So the next one is really the flip side of that equation there, and that's debit, where you have credit increasing the bar on liabilities. Debit is the increase in the asset side. And really that's just an increase in the asset or expense account, or it's decrease in the liability or equity account.
Yeah, next one is fixed costs. So obviously, this is a cost that does not change with the volume of sales. For example, this would be rent and salaries. Obviously, those get increased or changed over the year, but normally when you're looking at it, it's over a time frame of a year or whatever it may be. This is actually something interesting that I learned with homes. I'll talk about it another time for a housing episode. But yeah, basically, it's things that don't change. Obviously, if taxes go up, then that could change. Whether that be your rent or a mortgage or salary for the company.
Yeah, and maybe we definitely should do a housing. We still haven't done our real estate episode, so I think that's a good one to do.
I've learned a lot about real estate for sure, buying a house. So I definitely have a lot of key terms, and I won't call them hacks, but definitely things to look out for when you're buying your.
I'm ready to learn. Let's do it.
Yeah,
so the next one is variable cost. And these are the costs that change with the volume of sales and are, again, the opposite of fixed costs. So the variable cost will increase with more sales because they're an expense that is incurred in order to deliver those sales. So something that would be like a variable cost would be the cost of raw materials. Now, the raw materials are tied to commodity prices and labor markets as well. So those markets are externalized and will change with sort of the market flow.
Yep. The next one's called the Generally Accepted Accounting Principles, or more commonly called GAAP accounting principles. It's basically a set of rules and guidelines developed by the accountants and either the SEC or one of the regulating bodies, basically for reporting financial data. So these rules are critical for all publicly traded companies. Private companies, you can kind of do a lot of different things, and you're not as held strictly to those, but definitely for publicly traded companies, you have to abide by these, with your 10Ks, your 10Qs, your 8Ks, and all such.
So the next one, general ledger. This is an important one, especially when you're talking about managing a P&L or managing sort of like the financials of a given company or a business segment. And the general ledger is really the complete record of the company's financial transactions, typically before it's like consolidated into those financial statements that are reported. It's everything that's used in order to prepare those financial statements. And you might have heard GL or GL code. And those are essentially like the line items that would be used to drive specific categories in a respective financial statement. So like a GL code, let's say for overhead, that may include something like travel and entertainment. That may include payroll for office employees. So the GL code is really just a more specific line item of a given financial statement.
Yep. Next one, pretty simple one as well. Interest, it's the amount paid on the loan or line of credit that exceeds the repayment of the principal balance. Long story short, if you had $100 loan and it was 5% interest, you'd owe $105 over the course of repaying it back. Obviously, if you don't pay it back in full, that can compound the smaller amount. So if you don't pay the 105 or you only pay $50, they're going to compound, the $50 and the 5% continually over time.
Yeah. And this is a term that is good to avoid the interest, and that's liquidity. So that term is really how quickly something can be converted to cash. And essentially like an example would be stocks are more liquid than a house because you can kind of sell stocks in an app. Whereas a real estate, you may go through a broker, you'll have to list the house, you may have to do some work to the house. It's essentially just how expeditiously can you convert to cash? That's liquidity.
Yeah. Next one is material. Material is a term refers to whether information influences decisions. For example, if a company has a revenue in millions of dollars, an amount of 50 cents is hardly material. GAAP requires that all material considerations be disclosed. So much smaller expenses, they don't have to track when they buy a bunch of pencils for the office. Yeah, obviously, if they want to be good, that plant or office or facility will track that because obviously they're spending it, but it's not something that needs to be on, their balance sheet or their income statement or, any of those any of those sheets. It'll be kind of bundled up into one of the expense items.
Yeah, and sometimes material can also be included not as a financial change. A material change can also be in terms of like the senior leadership changing. So the way that you'll see a material change be noted, it'll be an 8K if filing in the United States. And that's really just like the filing of material changes to the business. That could be a new CEO, that could be an acquisition of a competitor, something like that. So material is just those big things that move the business and have to be reported. Do you want to take overhead?
Yeah, overhead are those expenses that are related to running the business. So normally overhead, it's not anything that goes into the product. It's the office space. It is the pencils, exactly that I said. It's the computers. It's the things, the rent, executive salaries. A lot of things can be lumped into that category, basically.
Great. And talking about salaries, the payroll, this is the term we're going to define next. It's really the account that shows payments to employee salaries, wages, bonuses, and deductions. And oftentimes this will appear in the balance sheet as a liability because that's the money that the company owes to their employees, especially if there is accrued vacation pay or unpaid wages. And that was actually something, if I am allowed to talk about this, that was something I went through when leaving my former company. There was one of those accounts payable on that company side was due to me for vacation that I had accrued. So that was, I received a check upon leaving the company. So that's an example of that.
That's pretty cool. Next one is present value. So present value is a term that refers to the value of an asset today as opposed to a different point in time. It's based on the theory that the cash today is more valuable than the cash due tomorrow due to the concept of inflation, which I know Ben and I have talked about before, and how we're printing trillions of dollars. So, your money, the houses were worth a lot more, or your money was worth a lot more 20 years ago than it is today because of just the number of dollars out in circulation. So you can buy less with the current dollars that you have.
Perfect. And lastly, we could go on forever, and I appreciate you guys hanging with us to go through this rapid fire of really we're walking through just a comprehensive glossary of just business accounting. This last one that we'd love to see from the investment side is return on investment, or ROI. And this term really referred to the profit that a company was making, the return divided by the investment period. But typically, this term is used more loosely to include returns on various projects and objectives. So ROI typically is looked at from like a stock perspective, but internally from the business's side, you're defining really like how much did this project pay back. So for example, if a company spent $1,000 on marketing and you could tie that confidently to a $2,000 in profit, the company could state that the ROI on marketing spend is 50%, and double digit is always nice. So something to be mindful of. But yeah, that is pretty much it for what we want to cover on sort of accounting basics 101 with Chris and I.
Yeah.
Chris, I'll pass it off to you.
Yeah, I mean, Ben, if you want to showcase your T-shirt,
Let's go.
Put your camera down, or stand up to show your shirt. Obviously, we are pitching. Our shop is open. It's running. It's the best of my knowledge, it's running well. Everyone's receiving their products.
It is running well,
ordering.
I think.
Yeah, so you can definitely check out our website. Check out all our shirts, hats. We have hats on there, right? Yeah,
we do. We have hats now.
The hats, the mugs. We have 2 different types of mugs, bags. You name it. Pretty excited for that. We've got more news coming. I know Ben and I keep saying that, but it's true. You just can't announce it yet. We're kind of going through the process again.
Yeah, we've got a couple things in motion, and we've been a little bit. Well, I have been a little bit off the radar. Just personal changes with me going. So just to make the quick announcement, I'm going to be working out in California end of fall. So Chris has just been an awesome friend in working with my really, really tumultuous schedule to work around California time and my various travels. So you're going to be hearing a lot more from us going forward once things start getting settled in from my end. I know you saw the Lone Amateur episode last week. So yeah, we've got 2 really exciting things coming down the pipeline. The store really shows the love for the amateur investors. We love seeing you folks like post your shirts, your hats, your bags. We're going to have a post about the new items that are going to be coming out in the line, and we'll try to link directly to the store. So yeah, we're excited about what's to come. What else you got, Chris?
Aside from that, social media channels, YouTube, Spotify, rating, review, like, comment, anything. I'll get back to anyone who's not a robot. I'm kind of tired of seeing robots comment on our videos. It kind of gets my hopes up that they're shilling some cryptocurrency or some get-rich-quick scheme. I promise if anyone is we are not big enough yet that they're impersonating us. But if anyone is impersonating us and we are telling you that send us money or we'll get you rich real quick, it is not us. We are not going to ask you to send us money like that, except in the form of buying stuff from our shop. But we do not have any get rich quick schemes. We're not going to be selling you like, hey, this is how you get money. Send it to us. We'll send you money back. That is not us. So that's just a forewarning. Don't get scammed out there. That's pretty much it. Ben, anything else you got?
No, just continue to follow, like, and subscribe to the show. We're still cooking along, and we've got some guests coming up pretty soon. So I'm excited about that. And as always, if you folks have a topic that in mind that you'd like us to cover and do some research on, like Chris and I selfishly always want to learn. And that's really what the project of this or the purpose of this project is to learn and share what we learn. So anything you guys want to learn about, we'll make it happen and we'll dig right in. That's what being an amateur is all about. You can learn about anything and have fun doing it. So thank you guys as always for watching, listening. We'll see you next week.
Have a good one, everyone.